Today, we're diving into something huge that's reshaping our economy, a multi-trillion-dollar flow of money that's kind of happening just beneath the surface. It's called private credit, and believe it or not, it's actually changing how the Federal Reserve's policies even work.
So let's start with a pretty basic question. When the Fed jacks up interest rates to cool things down, what's the textbook answer? Well, the flow of money is supposed to get squeezed, right? Banks are supposed to pull back, credit gets way harder to find, and businesses slow down their spending. I mean, that's the main tool in their toolbox. But check this out. Look at what actually happened during those really aggressive rate hikes back in 2022. This chart lays out the whole mystery perfectly. You see that dashed line? That's bank lending to businesses slowing down, just like you'd expect. But now, look at the dotted line. That's total credit. It didn't fall off a cliff. Something else was keeping the money taps open, and it stopped a full-blown credit crunch. So what on earth was going on? Well, the answer lies in the absolutely explosive growth of this parallel financial universe, private credit. This is where lenders that aren't banks are stepping in to fill that exact gap. And a really key player in this whole world is something called a business development company, or a BDC for short. You can pretty much think of them as these specialized investment funds that act a lot like banks, but they don't take deposits. Their entire business is just lending money directly to those medium-sized companies, the real engine of the U.S. economy. Okay, so here's where it gets really interesting. Where do these BDCs get a huge piece of their funding? You guessed it, from the traditional banks. It's wild. As you can see here, while banks were cutting back on loans directly to businesses, their lending to BDCs just went through the roof. It's like the money just found a new kind of sneaky back road to get to where it needed to go. And all of this creates this fascinating and, for the most part, hidden new pipeline for credit in the economy. So let's just walk through how this works. Step 1, the Fed tightens its policy. Step 2, a business that can't get a loan from its regular bank anymore goes and knocks on the door of a BDC. And then, step 3, to fund that loan, the BDC just taps into its own massive credit line, which it gets from a big bank. You see? The money is still coming from the banking system. It's just flowing through this new middleman. But, of course, this new pipeline isn't free. There's a toll, and this chart shows you the cost perfectly. That solid line is the interest rate banks were charging BDCs, and as you can see during that 2022 tightening, it just shot up way faster and way higher than the rates for other businesses, which is that dashed line. The banks were charging these middlemen a serious premium, and, well, that cost has to go somewhere. This whole process really creates a fundamental shift in how the Fed's policies actually hit the real economy. It leads to what you could call a tale of two different channels.
So here it is, the crucial trade-off. On the one hand, the Fed's power to actually squeeze the amount of money flowing around is weaker. Credit is still available, which helps stop a big recession. But on the other hand, the Fed's impact on the price of that money is amplified big time. Those rate hikes get passed right down the chain, from the bank to the BDC, all the way to the final business borrowing the money, making every single dollar a whole lot more expensive.
And hey, don't just take my word for it. The researchers who uncovered this whole thing put it perfectly. They said that private credit basically dampens the quantity channel, but intensifies the price channel. In other words, the Fed's medicine still works. It just affects the patient, the economy, in a totally different way now.
Okay, so let's get down to the real world. What does this trade-off actually mean for the companies that are taking on all this more expensive debt? This table tells a really powerful story. It compares the firms that switched from bank debt to BDC debt, let's call them the switchers, against the companies that were able to stick with their banks. Now, on the one hand, the switchers' asset growth was, wow, a staggering 45%. They got the cash they needed to expand, no doubt. But what was the cost? Well, their ability to actually cover their interest payments was way lower, and their probability of defaulting was almost double. And to put an even finer point on it, on average, the companies that really relied on this BDC credit saw their ability to cover their interest payments fall by a whopping 30% during that rate hiking cycle. That is a massive, massive increase in financial pressure. This whole new reality fundamentally changes the game for economic policymakers. The old playbook, it might not work the same way anymore. So if you boil this all down, here's the key takeaway. This private credit pipeline, it's acting like a shock absorber, right? It's stopping the economy from completely seizing up when the Fed hits the brakes. But, and this is a big but, it's doing that by taking all that shock and concentrating the risk in a much less regulated, much murkier corner of the financial system.
And that leaves us with one final, really critical question that policymakers are wrestling with right now. If this private credit world is now the one absorbing so much economic stress, is it also quietly building up a huge amount of systemic risk just out of sight of the traditional regulators? That is the trillion-dollar question for the future of our financial stability. And of course, just a reminder, this is not financial advice.